Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get back to McDonald's. Michael Halen is Bloomberg Intelligence Senior Restaurant and Food Service Analyst joining us on McDonald's earnings. Hey, Michael, what was your bigger takeaway here?
Yeah, I guess, the biggest takeaway is that they still have work to do. The stocks performed pretty well here. I guess results weren't as bad as expected. July data that we've seen is pretty bad. So the fact that they're still negative isn't really surprising. But they definitely still have work to do. The $5 meal deal seems to be bringing in some traffic. They're hopeful that, the sales will follow, but it hasn't happened yet. And they talked about the U.S. really needing a revamp of its 1, 2, 3 dollar value meal, but we see the stock doing well, and it's for good reason. This company has scale that nobody else does. They can offer price points that nobody else can. They have a ton of marketing might. So for those reasons, in this really competitive market where chains are fighting hard to attract low income consumers, McDonald's definitely has the tools to win.
For me, the McDonald's experience was always an airport experience, because I could always say, I could justify if I say, hey, I'm rushed for time, I got to make my flight, get something quick. But now all the new airports and like the renovated Newark airport, there's no fast food in those things anymore. You have to sit down and order and do all that kind of stuff. So that's why I haven't.
That's interesting. But isn't there fast food, but it's like nice stuff, like wraps?
Well, you can
salads.
get that stuff to go, but I mean, you could always get like some fast food, serious fast food. All right, so Mike, what's the story for McDonald's here? Do they open stores? Do they rationalize their footprint? What's kind of the strategy there in terms of managing their footprint these days?
Yeah, well, they're in their investor day late last year, they pushed for more aggressive store openings, right? And so that's going to continue to be the focus. They're going to push hard to grow internationally. China obviously is a big point of focus for them. But yeah, it's going to be to open stores. But in order to motivate their franchisees to open stores, they're going to have to, have a strong marketing program that's going to pull people into the restaurants, the existing restaurants, grow same-store sales, improve profitability, and make it just a more attractive proposition for their international and U.S. franchisees to open new stores. Didn't
they unveil like a $5 meal thingy? But that was at the end of the quarter, right? So we don't really know the full impact of that for McDonald's?
Yes. So on the call, management said that it's driving traffic, but not price, but not sales yet. So it seems like there's some trade down from current customers saying, well, $5, I get a lot of food for that $5. So maybe instead of getting a Big Mac meal, I'll get this $5 meal deal. But so it hasn't really impacted results yet, but they said that, historically traffic comes before the sales boost. And so they seem positive on it in this near term. They said 93% of franchisees in the U.S. have agreed to extend this offer deeper into the summer. So they seem positive on it, but their real focus is going to have to be on the $1, $2, $3 value menu. That menu isn't resonating with customers, right? And it seems like a full revamp is in the cards. They've received a lot of shade on social media that you can't find anything on that menu for $1, right? And so some re-engineering is going to be necessary here in the United States.
All right, dumb question of the day comes from me.
Never.
At McDonald's, Burger King, even Starbucks, the drive-through line, they're like 20 cars deep. I walk inside, I walk right up to the counter, and boom, I'm served. What is it about Americans that they into this drive-through thing? And if I'm a McDonald's, isn't that a source of opportunity for me to figure out how to get them through faster?
Yeah, well, I guess we're lazy. That's the problem, right? But no, to your point, a big percentage. Historically, the counter was like, say, 15% of a drive-through restaurant sales, and historically, that's really just been used when the drive-through line is too long, and people say, I don't want to wait that long. I'm gonna go inside and pick up my stuff. So There is an opportunity. It's a point of focus for all of the quick service restaurants we cover. Everybody's constantly trying to improve their throughput, decrease the time waiting in line, because they know if there's, at a certain number of cars for McDonald's, historically it's been, say 5 or 6 cars in the drive-through, people will either drive past the restaurant, or maybe they'll say, you know what, I'll park and come in. But that's potentially business loss, right? So, improving throughput at the drive-through and at the counter is constantly a point.
Well, that's what I was going to say.
But
AI
hasn't been working though.
I mean, in theory, right? You get like an IA thingy to do the drive-through, right? But that has been really tough to manage right now, right? It's not really the best.
It's not working. I mean, they're having a lot of trouble with accents, not only from international customers, but also dialects across the United States. So voice ordering and a lot of these AI initiatives, there's a lot of potential with them, but they haven't been able to really pay dividends just yet.
All right. So what is the investment call here, Mike, for some of these fast service, McDonald's, Burger King? What's the investment call here for these names?
Well, they're looking at, it's interesting because the year-over-year comparisons, base effects get easier into the second half, but the consumer's weakening, right? And so, McDonald's said they expect, more consumer weakness over the next few quarters, right? And so there's definitely concern about restaurant spending here in the second half. I think I mentioned it at the top. McDonald's is well positioned though in periods of distress. During the Great Recession, they outperformed by offering value that competitors couldn't match, right? And so it's a very tough environment, but we think McDonald's is positioned pretty well for such a tough environment.
In the value war where everyone's chasing a smaller part of everyone's wallet, how do these guys remain profitable? I'm not just talking McDonald's, but like all its competitors too. Like it's sort of a race to the bottom to some perspective. How does that play out?
It's not just a race to the bottom. So in terms of the low end, they're trying hard to keep that low income consumer business, and there's no doubt that that's a big focus right now. But they're also bringing in middle income and higher income consumers into the fold, right? So you also get this traded down effect where, sure, low income consumers are trading down into grocery store, but McDonald's and some of their competitors, Jack in the Box being one, Chipotle, have been able to attract these higher income consumers that actually come in and buy premium items and spend more when they come. The problem is they're just a much lower percentage of the overall traffic. But that's what we've seen over the last year and a half or so, is chains that have been able to attract these higher income consumers are definitely outperforming.
So where in your overall space there, Mike, of on the restaurant side is the best place to be these days? It's
companies that provide a lot of value and a very good price point, right? And so like most earnings seasons and industries, a lot of the top performers end up reporting earnings first, and we've seen that Chipotle and Texas Roadhouse are two. They outperform everybody on same-store sales over the last 5 years, and there's not even a close second. And a big reason why they've outperformed by so much is that customers see a lot of value on that plate for the price that they pay. Right, and they're provided a pretty good customer experience, and that's what's bringing people in the door. If you're providing very strong everyday value and a good in-restaurant experience, clean restaurants, good service, whatever that, and everything that entails, then you're winning.
Got it. Simple business, but a tough business, that's for sure. Michael Halen,
Exactly.
Senior Restaurant and Food Service Analyst for Bloomberg Intelligence, bring us up to date on our good friends at McDonald's here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Busy week here. Economic data aplenty, including the Fed on Wednesday. Lots of earnings, particularly for some of the big tech names, which you think are going to be critical for this market. Let's check in with a professional who does this stuff for a living, Ann Bartels, Chief Investment Strategist at Sanctuary Wealth. Ann, thanks so much for joining us here. What's your 30,000-foot market call that you have to your clients? What are you telling your clients that they should be thinking about here as we head into the back half of this year?
Well, as you pointed out, it is the alphabet soup of news this week. The markets can go either way, but how we're telling clients to position is we actually think that we can actually rally this week. Markets are as oversold as they were back in April. When we came into this year, we called it the year of the bucking bull. And we've seen some bucks and we just got through some bucks, but we don't think we're done with that yet. We think we can rally one more time. And then I think the market bucks again in the fall, in September and October, the traditional seasonal, very weak period for the market, but then having a year-end rally. We're still expecting markets by the S&P 500 to be up about 20% this year. Wow. We still think the leadership of the market is intact. That's the Magnificent Seven, it's technology, and that semis are still the leaders. Remember, if we're going to go towards AI, you can't have AI without semiconductor chips.
So if the AI trade is still in place, the tech trade is still in place, how do you get comfortable with valuation in some of those names, or just within the S&P 500 in general?
That's a great question. I mean, obviously the valuations were very high. The markets were up by NASDAQ's representation 20%, where a lot of the tech names are. So between the market being extremely overbought, valuations extended, it was time for like a mean reversion kind of trade. Let's bring part of that in. But the reason why these tech names have such high valuation is because they have the strongest growth within the market. Although we're expecting good earnings this year, the market is not abundant with earnings. And when you don't have an abundance of earnings, you have a growth market. Fund managers and investors are willing to pay up for those earnings, so those stocks have higher multiples. So I'm comfortable with higher valuations, but maybe they just got a little bit too stretched. They've corrected, and we're still buyers of this market.
So how do you think about sectors outside of technology? Where do you see opportunities there outside of those big tech names?
Well, there's a couple of spaces. We like infrastructure. Biden has passed a lot of pieces of legislation that are really supporting the growth of the infrastructure of our economy. You're really going to see a lot of stocks within the industrial sector. Defense is also in there. Defense is behaving well. With interest rates coming down and with the Fed expected to cut rates in September, which we also anticipate by 25 basis points, you're starting to see some of the interest-sensitive parts of the market that have not done well, like utilities and REITs, we think have bottomed. Pockets of healthcare are doing better. Biotech has broken out. The breadth of the market has expanded, especially with that rally in July. And we actually hit a new high with breadth indicators, and the volume confirmed that. That's what really gives us confidence that we're still in a bull market and that we still want to be buying stocks here.
Well, that's kind of where I wanted to go, Marianne. We had, as you mentioned, kind of over the last several weeks, kind of a little bit of a rotation, maybe out of some of those Magnificent Seven names, maybe into some other areas of the market like small caps. We saw the Russell 2000 outperform the S&P by the most on record over a 2 or 3 week period. Is that trade, is that for real? Is it a flash in the pan? How do you think about that?
So we're not fans of small cap. It has been a very impressive rally, and we think the reason why it was so impressive is that fast money, typically called hedge funds, CTAs, many of them had short positions within small cap. And we think some of those positions were covered, not all of them, but some. We just don't think the earnings power is there for small cap to take over leadership. So we think it's impressive. If you've been there, it's been great, but it's not where we really want to be positioning our clients right now.
How about the fixed income here? You can sit here in a 2-year treasury and get 4.4%. That's not a bad way to make a living here. If I want to maybe take some credit risk, I can do better than that. How do you think about fixed income?
Yes. What we've been saying for a while is that interest rates have peaked, both at the short end and the long end of the curve. We think they're going to continue to come down. For clients that are in cash, that are getting 5% or even above 5%, we're warning them that can go away, especially if the Fed begins a rate cutting cycle. So we've been telling clients to come out of short duration assets and take a little bit more duration risk, go a little bit more in the middle of the curve, which is called the belly of the curve. And as you pointed out, you can take credit risk, but we are stressing to stay with quality.
When you take a look at quality, though, does it matter like why the Fed is cutting? As in, the economy is getting a lot weaker. We're looking ahead to the jobs number. Everyone's worried about the Claudia Sahm rule being triggered versus inflation coming down.
I think it is. The market thinks that cutting rates can be a negative. And historically, it is a negative because we're cutting for the wrong reasons. The economy is still growing a little bit slower. The consumer's still spending, but a lot slower. We're seeing manufacturing slow down. So I think in order to balance like unemployment, which, as you pointed out, the unemployment rate is going out, it's important to actually try not to have a recession. And with these warning signs that the economy is slowing, I think it would be very appropriate for the Fed to cut rates, but the market's not to negatively react because there's really nothing negatively wrong. In fact, what most people are not talking about is that the Fed has already started easing. They changed their position on their balance sheet. They started to have less run off their balance sheet, which is actually a form of easing. So I think the Fed has already been in easing mode. Now it will be official with them cutting rates if they do in September.
Would it be a problem for this market if they surprised us and did not cut in 2024?
Yes, absolutely.
Yeah, that'd be huge.
That would be a big surprise, both for equities and fixed income. Talk about a buck and bull. It's going to be buck and running the wrong way. So I don't think you'd want to do that to the markets. I know people have been speculating that maybe they'll cut at this meeting, but that would be a surprise as well. And I think that would be interpreted as negative as the Fed is panicking over some of the recent data. So I don't think they'll be cutting here. Powell has been pretty traditional in telling markets what he's going to be doing, and he pretty much sticks to that. So I think he's kind of hinted pretty strongly that it's September. It's going to be very interesting to see what they say in the meeting this week. But I'm still betting that it's 25 basis points in September.
Well, before we let you go, what language are you looking at to sort of firm that up? Because you're right, if Powell doesn't want to surprise the market, it either has to be clear in the statement in some way or clear in the press conference in some way.
Yes. So the Fed, Powell has sounded a little bit more dovish. That's kind of the tone, not as hawkish. His words and language have been a little bit softer and a little bit more open that things are potentially weakening. So it'll be interesting to see exactly what they say. And I think what I'm going to be looking for, are they so dovish that the market really starts pricing in a rate cut also for either November or December? Right now, it looks like 100% for September. Some are estimating it could happen in November and December, but that's what I'm really focused on. Do they hint that they cut more than once?
All right, Marianne, thank you so much for joining us. Ann Bartels, she's the Chief Investment Strategist at Sanctuary Wealth, joining us from New York via that Zoom thing. Appreciate it. There's another bull for you still out there. She was talking about a 20% total move in the S&P 500 for 2024, so still got some work to do. Although she's one of those folks, which I'm in that camp as well, which is, you've been in the market so long, you really get a sense of seasonality during the year. And I don't want to be anywhere near these markets in September and October. But that's just because my first year on Wall Street, I was September 1987, and that was October 1987.
Oh my!
That was grim. So
that's a little traumatizing for you.
Yeah, ever since, you don't want to be anywhere near these markets.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One other thing to look at in the market is Bitcoin, up by just 1.2%, but it's actually up $826. That's the highest level earlier today since mid-June. The latest catalyst was Donald Trump expanding his pro-crypto agenda. Plus, you got those expectations that a Fed's going to be inching its way towards a cut, probably in the fall, and that's also helping investor sentiment. So we needed to get the read on that, as well as other commodities, with Mike McGlone, Bloomberg Intelligence Senior Commodities Strategist. Do you buy the theory that President Trump comes out and says he's going to fire Gary Gensler and he loves all crypto things, it's going to be number one in the U.S., therefore, thus, Bitcoin goes up?
I'm impressed how you phrased the question, Alex, because most people seem to be believing that, but I look at it as there's no, and then the lesson you learn is no zealot like a convert. Obviously, he's converted because he hated crypto before, but I think he's finally realizing things we wrote 5 years ago. This space is nothing but good for America. It's most widely tracked crypto is not Bitcoin. It's actually Tether, the US dollar, trades more than Bitcoin, double on a daily basis, but it's impressive what he's doing and saying to get elected. And I think that's the number one thing. He's saying whatever he can to get elected, and that's what's happening. The crypto people have picked up onto it, but this rally sounds a little suspicious because it happened right during the conference, the Bitcoin conference that's in Tennessee now that used to be in Miami.
Why isn't it in Miami anymore?
Well, I heard that had some issues. I don't really dig into that, but it's kind of nice to see it move on because I just was on a couple calls this morning with people who were there. There's so much enthusiasm as you expect in crowds and people getting together and all trying to, as they say in the space, pump their bags. But it puts on my radars. This is when you want to be really careful with an asset that's basically 3 times the volatility of beta. The S&P 500 basically has been trading together with beta for 10 years, and I think the risks are that it leads the way lower. So I'm very skeptical. And the key thing I like to say about Bitcoin is a lot of the easy money has been made. We had the GBTC discount that's gone. That's a Grayscale Bitcoin Trust. We had the ETH discount that's gone, and things like MicroStrategy have performed so well. I think I'm quite skeptical now at these levels.
Well, when we go back to the fundamental part that President Trump was talking about in terms of wants to make the U.S. the Bitcoin hub and not say China or other countries, is that something that the U.S. could actually do?
Well, it already is. I mean, most of them trade in the U.S. The most widely traded crypto on the planet is tethered to the U.S. dollar. We did launch the ETFs in this country, but it went through that normal U.S. discourse that you don't have in China. China, it's been banned. So it already has. It's just, I think people just have to remember how the system in this country works. There is a rule of law. We fight it out. We come to the proper conclusion. And that's what's happening with Bitcoin. We do have ETFs. And it was our bias in the very beginning when we launched the Bloomberg Galaxy Crypto Index in 2018 that at some point ETFs will track this index and track broad indices. It's all heading that way. I guess Mr. Trump is trying to say it's going to head that way faster. But to me, what he's saying is very much just out to get votes, and it's a question of will he do it and can he do it?
Hey, Mike, for as long as I can remember, you've been telling us to just shut up and buy gold. It just recently hit an all-time high.
In a nice way.
It recently hit an all-time high. Can you just refresh us on why gold continues to go higher?
Well, the number one reason I think started with the unlimited friendship between President Xi and President Putin, and it changed the world dynamic. Now, top central banks of the world are buying gold. It's becoming the second reserve asset next to the euro, according to the World Gold Council. And that, to me, is an overwhelming force. But what's most significant lately is we have had major outflows in ETFs, which looks like they're just starting to turn back upward. So gold, to me, is the most enduring commodity I think is going to continue to perform. And I do like mentioning in the same space as crypto, because the way I see it with equities getting very expensive, I've been saying for a while, you can't hold gold without some Bitcoin in that space, the digital version. But at some point, I think on a risk-adjusted basis, you're better off overweight in the metal and the analog metal. I think that's what's happening now. That's starting to get a sentiment shift. And the way I see it, deflation in the commodities is propelling inflation in gold. So I'll end with this. Right. The Bloomberg Commodity Index, spot index, is right now down on the year. It was up 12% in May, and gold just keeps marching along. I think those trends are going to continue.
So to that point, and this also goes to, I think, the crypto move as well, is there an idea that if the Fed actually cuts, that inflation comes back, and then that's another reason why we're seeing, say, gold and crypto rallying?
I think that's the potential if they cut too fast, but it's the lessons of human nature and history, Alex, are playing out here. We all know that we created too much liquidity and too much inflation. Now, we had a good reason. We all thought we were going to die 4 years ago. Now we're at this space now that I think the Fed's it can't cut yet because the stock market's so strong and such a relevant part of GDP, 2 times GDP. It looks like they're going to be behind the curve. The way I see gold, though, it's the most enduring. It's the alternative to treasuries. I think it's the risk-off trade where you look at what's been the most beat-up asset for the last 3 years. Long bond U.S. Treasuries. I think that trade's going to be happening together where gold goes up and Treasury bond yields decline. And a good indication is what's happening in China. 2.15%. That's the 10-year note yield in China right now. It's the lowest in our database since 2006.
Mike, I want to take you back to your roots, back on the great American farm. Boy, I'm looking at some of these agricultural things, corn, cotton, soybeans, all down kind of 15, 20%. Tough time to be an American farmer?
So how did you know I was there last week? All my family is in the Midwest. And I always do my crop tours, and I have to admit, I meet with family and friends and people who farm the land. I've never seen a more luscious situation. The crop is huge. The weather's been wonderful. The hurricane, it put a swath of rain right in the middle of the corn bed, right during tasseling when corn needs it the most in July. So the supply is massive, and the problem is we still have supply left over from last year. So I'll end with this. It's the key fact of the high price cure. Prices got too high. Supply is massive because prices got high. And now we have to get to the low price cure. And I don't know where that's going to be. And we're going into harvest with oversupply and a good crop, which means lower prices.
How volatile is the weather for farmers right now?
That's the key thing that's been happening, Alex, is you have more volatile minor events like derecho and like spot droughts. But what's happening this year is we have more moisture than normal in the corn belt. I hear that's related to sunspots and things like that. And it's actually been a little bit cooler. So it's almost perfect for grain production, somewhat of a greenhouse effect. But the thing is, I think it's the quote I heard in the Midwest. They always say Brazil, 19 years in a row of increasing production of soybeans out of Brazil. It's just prices are high, and it's a global competitive situation. And here's the quote I like to point out is, the whole thing that Mark Twain used to say, you might as well buy land because they don't create it anymore. But the farmers in the Midwest say, well, they are creating it in Brazil.
All right. Hey, we appreciate you all the time, Mike. Thanks a lot, Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. When are we going to Miami? Sometime in October, right?
Potentially, yes.
Okay, potentially.
So if we are, we're going to go knock on Mike's door.
Yeah.
We'll just invite ourselves in.
Yeah.
Yep.
We're going to be there, so look for us. We will keep you posted.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio in New York City. And we're also streaming live on YouTube, so you can go over there and search Bloomberg Podcast, and that's where you'll find it. Busy economic data week this week. I think kind of capped off. We got jobs at the end of the week, but also we got the Fed decision coming up on Wednesday. 2 p.m. will be the decision. 2:30 press conference, all Wall Street time. Bloomberg will be covering it for you. Michael McKee taking the Acela train down to D.C., and he'll be all set to go there. What do they do? That's the question here. RJ Gallo, he's a senior portfolio manager for fixed income at Federated Hermes on Zoom from one of my favorite towns in the U.S., Pittsburgh. Big fan. I think they punch way above their weight in Pittsburgh. RJ, talk to us about what you expect to hear from your Federal Reserve on Wednesday.
Good morning. Glad to hear you're fond of my hometown.
Love it.
In terms of the Fed, there's no dots. There's always a press conference and there's always a statement. I feel like Powell and company have laid the groundwork for the further embrace of the idea that the dual mandate has returned. For much of the last 12 to 18 months, the Fed had operated almost as if they were a single mandate central bank, fighting inflation, full stop. Of course, that's not their case. Their charge is a dual mandate. It's maximum employment, stable prices, fighting inflation. And the maximum employment element of the dual mandate is very much back on the table. Now that you've got inflation in a range that's tolerable and it appears to be likely to continue to decelerate, the Fed has laid the groundwork to focus on jobs again. The unemployment rate is up. It's a 4.1%. It's up a little over 0.4 from its lows. That's enough to get the Fed to pivot, I think, back in towards this easing mode. Remember, the market outran the Fed at the end of last year. We spent all of the winter and spring pushing back on the market. You had negative total returns for bonds. But since April 30th, you've gotten more constructive returns to bonds. So the Treasury index is up almost 4% since then, as the inflation has cooperated and the Fed has reopened the door to easing. And I think they're going to address that at this coming meeting without actually changing rates.
So why not just cut now?
That's a great question. I think that the Fed, it all comes down to that word confidence, which you've heard them uttering quite a bit lately. Recall it wasn't that long ago that the Fed had high confidence that inflation was going to be transitory. That obviously wasn't the case. I think that they feel now they would like to see yet more data. There's a risk there, of course. If the market expects you to cut in September, you're at a meeting, this week, and you're anticipating that the data will cooperate between now and September. There's a lot of uncertainty here. the risk that they're taking is that the inflation data will continue to moderate, but the jobs data won't fall off some sort of cliff. Probably a reasonable risk. The economy seems to have decent momentum. Q2 GDP data turned out to be stronger than anticipated. It's true that the jobs market's lost some of its verve, but it's still very much expanding in the sense that jobs keep getting created at a pretty reasonable pace. So it's a bet they're willing to take. If they were to ease this week, I think that would telegraph to markets that the Fed has gotten much more concerned about the employment part of their mandate, and it might sort of backfire. Bond yields would probably rally, collapse much more rapidly, maybe 25, 30 basis points, because people would be concerned that the Fed is anticipating greater economic weakness. In so doing, it could actually blow back in the other direction, keep the economy buoyant, and then inflation doesn't cooperate. There's not a pure science here. There's a lot of judgment, and in their judgment, they think waiting is a reasonable risk.
RJ, I'm a big fan of municipal bonds. I like to think of myself as one of the larger private creditors to the state of New Jersey through my municipal bond holdings. What do you think about the muni market here?
Well, the muni market, if you look back, there's very, very strong correlations in total returns between munis and treasuries. If you look at monthly total returns for 25 years, the correlation of returns is around 60%. It's not 100, but it's still high. So interest rates are the driving theme that link the muni market to the taxable market. That is very clear. Beyond that, you worry a lot about muni-specific dynamics. For example, expected changes in tax rates or changes in the supply of munis coming into the marketplace. This year, supply has been heavy, but demand has been buoyant, and muni ratios have remained relatively rich, sort of below long-term averages. Why is that? I think there is some concern that tax rates might be rising as we move forward down the calendar here. The Trump tax cuts basically sunset with respect to personal income tax rates. Investors are, I think, motivated to lock in some still relatively high muni yields, in part because the interest rate cycle has pushed yields up, and in part because they think taxes might be going up in the future. If Trump gets reelected, he'll probably try to extend all those personal tax rates, and muni returns might actually sort of be a little vulnerable. Even if interest rates are coming down, munis might not keep up and rally quite as hard. In short, we think munis are still a pretty safe place to be from a credit standpoint. The rates scenario is probably getting more constructive. The tax policy scenario and the related supply dynamic have been the greater questions. But those are sort of tolerable risks in the near term. Mm-hmm. I think munis are a pretty good place to be for you and for many others.
Okay, yeah. So you love munis, but then you take every Friday off, and then I'm at the muni segment.
I know.
And I'm literally prepping all week to make it through my muni segment. RJ, talk to me about the curve. Do we get that steepener finally? What does the steepener look like? Is it going to be because buying in the front end or a sell-off in the long end? And what does all that wind up meaning?
Great questions. On the month, so July is almost over, right? So the 2s, 10s, and the 530s Treasuries curves have steepened 15 and 17 basis points, and the 230, very long curve, has steepened 23 basis points. The steepener is working. At Federated Hermes, we sort of look at the top-down drivers of fixed income portfolios, duration, curve, credit, and we assemble some of our top people in what we call alpha pods or investment committees. Our yield curve committee has been very successful positioning for the steepening that has occurred. We think there's still more to come. The steepening typically is resulting from a couple things. One, even though inflation's come down, which would make you feel like the curve should flatten, the curve's been inverted for so long that the fact that the Fed has opened the door to easing, as we were talking about a few moments ago, that has helped the curve to steepen back out. The curve should steepen so long as the Fed continues in that easing direction, number one. Number two, so long as the economy doesn't sort of stumble rapidly or inflation resurges. So we think that the yield curve is working for us. We still like the bet. In the muni space, the curve's been strangely U-shaped, heavily driven by expectations for a softer Fed. And as the Fed's moved in that direction, the U is hollowing out. It hasn't fully become an upward sloping curve just yet, but the same dynamic that manifested in treasuries is now working in terms of sort of making a more reasonable shape for the muni curve as well.
How much credit risk are you guys willing to take these days?
So the muni credit scenario has been very favorable. The long economic expansion post-pandemic, which has outpaced most people's expectations in terms of job creation and in terms of outright GDP growth, that's a rising tide that lifts all muni boats. State governments are doing well. You mentioned the state of New Jersey. They've been upgraded into the single A range. You even had the state of Illinois, which at one point a number of years ago, we were debating whether they should be a junk bond. They've been upgraded into the single A range. We've had I don't know if it's been a golden era, but it's been a strong period for muni credit, both at the state level and the local level. The local levels benefited sharply from rising property valuations. We all worry about commercial real estate, specifically offices, but when you consider that residential real estate has surged and many municipalities in this country have more residential than office in their tax base, generally speaking, local governments are also doing relatively well. In a world like that, so long as we anticipate the economy still growing and the Fed's moving towards an ease, we're still happy to take mid and low quality credit risk in our muni portfolio. So we've been overweight A's and overweight in the high yield space, and it's worked. That's been the best performing part of the muni market on a year-to-date basis by far. Going forward, spreads are a little tighter. It's probably a little less compelling, but we still like the carry idea. And so long as the Fed's easing and the economy is not tanking, taking some credit risk in munis is probably the right place to be.
Hey, RJ, we really appreciate you. Thank you very much, RJ Gallo, Senior Portfolio Manager. Great insight there. Fixed income over at Federated Hermes joining us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get back to the markets. Nora was just talking about this, but Heineken, those shares are down almost 10% over in Europe, it's taking about a $949 million hit from China, giving a cautious outlook. And it wasn't just China, it's also U.S. and Europe as well. So we want to get more on that and head to our Bloomberg Intelligence folks. Duncan Fox is Bloomberg Intelligence Consumer Staples Analyst, is joining us. Hey, Duncan, can you run us through the laundry list of the things that were a problem for Heineken this quarter?
Well, I suppose the main one was consumer sentiment is still quite weak. So what they were hoping for was a bit of a bounce back in Europe for volume with the Euro 2024. But unfortunately, the weather was just, again, poor in Northern Europe. So that was a hit. In China, it's just that China Resources beer share price has been below the price they bought it for about 4 or 5 months now, and the accounting system means they have to take that hit. So if that share price goes back up again whenever the Chinese economy recovers, then they'll get some sort of recovery from that, but I can't tell you when that will be. So it's just dull consumer.
So what is Heineken saying about just underlying demand in general? What are they saying about the consumer, and is there regional differences, I guess?
Basically, the consumer's been hit by inflation for the last 2 years, probably double-digit pricing, and I think they're just paring back. The big problem is that people are not really going to the pub as much, the on-trade. That's where they make great profit. Well, in Europe, it's certainly been the case. And in places like Africa, where you've had devaluation as well, you've just got to work your way through that. And they've done a very good job, actually, but you still have the short-term issue. Where Nigeria is a big market for them, and you get a massive devaluation, and so they're just working their way through all these issues. They're doing actually quite a good job on the ground, but weather was the real thing that was a surprise. I mean, the upgraded guidance a little, but I think people were expecting a bit more because of the Euro 24.
So Paul brought up sort of those mixed infused cocktails and stuff. I can get a mimosa in a can. It's not terrible at all. Does Heineken have exposure to that kind of stuff, and is that sort of eroding the appeal of beer at all?
Well, beer's getting it from every angle, really, because you're seeing a lot of these new odd drinks. I probably agree with Paul on that one. Some of them are a bit weird, but they've got Desperado, which is a spirit-based beer, a tequila-based beer, which is doing very well. So they have got things that they can attack these products with, but you need to keep basically innovating with new things all the time. Diageo are doing a pretty good job on trying to do that, but the problem is some of these don't last very long, the 18 months, and then things sort of fall off a cliff. So you've got to sort of keep replacing them, otherwise you get into a bit of trouble. So actually the Heineken one's doing well, but they just haven't come up with innovation in that area. it's probably not their key area for them.
Hey, Duncan, if I were to go later on today to Sandbanks Beach in Dorset, which is in the southwest of England, is it a beach day today? Am I going to get what's it like out there at Sandbanks Beach?
Beautiful. It's absolutely beautiful here today. I'm about 40 miles away from it, but if I could get there, I would. I'd go to a different beach this evening, and it's beautiful. About 24 degrees, very sunny, lovely.
Lovely. See?
Perfect day for a beer.
Perfect day for a beer. So that's some kind of segue. So let's go to that, Duncan. Is Heineken calling out different regions of the world behaving differently? Is the U.S. market stronger than the European market or Asia?
If you have a nice beach, your sales are up?
Exactly.
Well, certainly if the sun's out. They're not that big in the U.S. Latin America, they're big, and they've taken quite a lot of cost out. They were importing bottles to Brazil, for instance, which is a huge market for them. So they've taken the cost down. So it's not particularly great consumer environment there, but the profits are improving because they've realigned their cost base. In Asia, they're bouncing back from a really horrid time last year, where the economies, Vietnam in particular, had a terrible time in sort of Q2 and Q3 last year. So that's bouncing back. I wouldn't say the beer market, because of regulation, is buoyant, but they're gaining share, and they've done innovation on the beer market there that seems to be working very well. So there are a few issues in Asia that they've still got to overcome. China, it's quite a chunky bit of their market now, so they need to see that economy improve. Places like Cambodia have got a bit of an issue in the short term because of the economic growth. So it's just a case of good old policies from governments turning the economies around. Consumer get a bit happier with life, and people then go out and buy beer.
We were also just talking to our Bloomberg Equities reporter at Norma Linda about Constellation Brands. That stock getting dragged down by Heineken. Is that a fair assessment? Like, is Heineken a warning sign to all the alcohol producing companies, or is a lot of this just a Heineken specific issue?
I think it shows it's a difficult time for beer companies in particular. I mean, there was a hope that the summer of sport would give them a nice fillip, but if the weather's bad, you just can't get that volume. People have to go out and buy the beer, preferably the premium beers. So, that's going to hit maybe ABI, Constellation a little bit, but they're in completely different markets. I don't know. I don't cover Constellation, but I think they're doing very, very well in the US, taking share off ABI after last year's marketing errors. And it does seem that premium beer is doing quite well. I mean, Heineken had 9% volume growth for the half for their Heineken brand, which sells at about a 25-30% premium to mainstream beer. So there are pockets in there that are doing well. If you've got good premium brands, you can do well. Spirits, we get the main results tomorrow, so that could be interesting. But we know there's sort of inventory issues there that need to be sort of ticked off before you'll see a recovery. If Diageo and Campari say that, then we could you could see a shift out of beer, maybe back into spirits in the short term. But
all right, Duncan, thanks very much. Appreciate it. Duncan Fox, consumer staples analyst, Bloomberg Intelligence, zooming in from lovely Dorset on the southwest coast of England. Something to think about heading out to the beach there.
All right.
24. This is how you convert. This is how I convert Celsius into. Okay. I double it and add 30. And that gets me pretty darn close. So 24 degrees Celsius, 48 plus 30, 78. That's a nice day. That's about as good as it gets in England.
I like that. Guessing. Double it, add 30.
Yep.
Okay, I'm going to use that because sometimes, I just kind of guesstimate it. You don't know if it's true. Anyway.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.